Welcome to the 3Edge Week in Review for the week of June 9th. I'm Fritz Folts, the Chief Investment Strategist at 3Edge, and joining me here once again today is Steve Cucchiaro, the CEO and Chief Investment Officer here at 3Edge Asset Management. For many years now, U.S. stocks have outperformed international stocks. However, even as the S&P closes in on its record high set in February of 2025, international stocks have been outperforming the U.S. stock market and doing so in rather dramatic fashion. For example, year to date, while the S&P is up around 3%, the German stock market, referred to as a German DAX, that's up over 30%. Japanese stocks are up over 10%, and a diversified portfolio of emerging market equities is up around 14.5%. And even China, which despite its ongoing trade tensions, is up almost 20% this year. So the questions that Steve and I will be addressing here today are: why have international equities been outperforming U.S. stock market thus far in 2025? And could the trend continue? And what would it take for U.S. equities to regain their outperformance over international stocks? And of course, as we always do, we'll discuss how investors might think about adjusting their portfolios to take advantage of the potential for international stocks to continue their outperformance of U.S. equities from here. So let's get started. Let me bring Steve in. And Steve, maybe we could just start and say, okay, this is not something that's occurred for many years now, but why would it be that here in 2025, international stocks are just doing so much better than the U.S. stock market?
Well, you're right, Fritz. Over the past several decades, outperformance between the U.S. and the international stocks has alternated in multi-year periods. And I just want to point out to the accompanying chart that shows the pendulum does swing back and forth over the years, over the decades, and each takes a turn of outperformance. Now, at the end of every such multi-year period, valuations get so stretched because of the outperformance of one over the other that eventually there's a turning point, but it doesn't come just because valuations get stretched. It comes when there's a certain catalyst. So 2025, we've had an obvious catalyst, and it's the big jump in radical uncertainty that's associated with changes in tariff policies, changes in fiscal and tax policies, the fear of runaway U.S. debt, threat of sanctions, and the so-called revenge tax, which is provision in the tax bill that's under consideration by Congress, Section 899, that would actually penalize foreign investors if they put capital into the U.S. So all these reasons have made U.S. dollar-based assets less attractive to foreign investors. Now, if you think about it, with less trust in U.S. policy, foreign countries are seeking to become more self-reliant. And coupled with their relative undervaluation, U.S. policies are actually boosting the prospects for foreign assets. So when the U.S. dollar rose for a long period of time, while the U.S. was outperforming, foreign investors get a double gain by investing in the U.S. They not only made money in the stock market, but they also made money from the currency going ever higher. Now that the U.S. dollar is declining, and it's declined quite substantially this year already, it's become much more expensive for foreign investors to hedge foreign exchange risk. And that cost is offsetting what they might see as potential gain from investing in U.S.-based assets. So it's no surprise that many international stock markets are up this year by, as you pointed out, substantial margins. While the U.S. stock market return so far this year is similar to a cash or money market account, however, with a whole lot more volatility.
Right. Excellent. Okay, so now we have a better understanding of why, at least so far, international stocks have been doing better. The question now, I guess, would be, well, do you see this trend continuing? And so that's one part of it. And then the other is, what would have to happen that would allow the U.S. stock market to once again, regain dominance over international equities?
Well, if tariffs just went away before inflation took hold, if the final U.S. budget coming out of Congress showed control over the government debt, foreign investors may be more comfortable going back to hold U.S. dollars and U.S. dollar-based debt and assets. That would be supportive of U.S. bonds. That means yields would come down. That would give the Fed cover to be able to cut rates. All that would be, again, beneficial for U.S. stocks, at least in the short term. And if all that happens and we avoid stagflation and U.S. tech companies continue to produce strong earnings growth, then we could see the U.S. market going back to outperforming. Because of the excessive overvaluation, it's not inconceivable that overvalued markets get even more and more overvalued. However, the further that bubble stretches, then at some point the inevitable correction will come, and that inevitable correction could be even more risky and more severe down the road.
All right, excellent. So as always, my final question is based on what we've discussed here today about really the ascendance of international stocks here in 2025. Should investors consider adjusting their equity holdings to include more international stocks? And if they were to do that, how might they do that? What would make sense?
Well, across our core strategies, we are already and have been this year currently allocating more to international stocks than to U.S. stocks within our overall equity allocation. And that has been helping performance this year. Ways to invest in international stocks include ETFs that are based on broadly based indices, like the World All Country Equity Index, excluding the U.S., or there are some regional ETFs like the broadly based Emerging Market Equity Index that includes many different emerging markets. Then there are some more country-specific allocations we made, one to Japan, another to India. And right now, in our models, Japan and India are considered relatively attractive at this time. Now, going back to your other question, we do think international has room to continue to outperform based on relative valuations, even though it's had such a great year. It's just like the tip of the iceberg of what would have to happen to get back to the U.S. type valuations. So this could really have some legs. So in a bull market, we think it's still a good strategy. Now, we wouldn't say, go ahead and put all your money in international stocks because there's still a lot of risks that can affect the global stock market, the global economy. And in a bear market, even if international stocks outperform, they might only outperform because they go down more slowly or they don't go down as far as an overvalued market like the U.S. So we still want to make money. It's not just about relative performance. So we still want to be measured in terms of how much we allocate. Now, stagflation risks still remain. And not only because of economic reasons that we've discussed many times before, but also growing geopolitical conflicts. And particularly worrying is increased tensions with Iran in the Middle East. And we know in the past, when there have been increased tensions in the Middle East, sometimes you can get a spike in crude oil prices, and that can be very stagflationary. So we are still very strong advocates to complement any equity allocations with those assets and those investments that continue to hedge against the threat of stagflation. That includes hard assets like gold, includes shorter-term TIPS, Treasury Inflation Protection Securities, and it includes Treasury bills, which remain as an important hedge and cushion and dry powder for the future.
Excellent. And I suppose one thing that's important to point out is the decision doesn't have to be binary, right? You don't have to be either all in U.S. equity or all international. You can have, as we do, have a combination.
That's a really good point, Fritz, because sometimes investors feel extra stress because they almost approach it as an all or nothing. They don't know which way to turn. It doesn't have to be all or nothing, like you say.
Excellent. All right, Steve, thank you very much. Certainly been a while since international stocks have outpaced U.S. market, so we'll have to wait and see if this is a trend or just a bump in the road for the U.S. equity markets. One thing is certain, here at 3Edge, we're a global firm, and we'll continue to look for opportunities in both the U.S. and the ex-U.S. markets on behalf of our clients. So that will do it for Steve and me for this week. As a reminder, all our videos are always on our YouTube channel. If you go to YouTube, type in 3Edge Asset Management, you will see our entire library of short videos. And if you know someone you think might benefit from these videos, please feel free to share them. And lastly, if you enjoy them, please consider subscribing to our 3Edge YouTube channel. We'd be most appreciative. So until next time, on behalf of Steve and everyone here at 3Edge, thanks for listening.